India is going to get richer. How much richer is the question. The fund got raised in 99-2000 time period, and that was fund 1 for us. We are now in fund 9. 25 years where we've continued to scale and grow. When you think about timing the exit, right, which is what most people struggle with, there are only 3 sort of possible outcomes. Either you're going to sell exactly right, or you're going to sell too early, or you're going to sell too late. That's what I tell myself, right? Either you believe you can sell it, on the hour, on the dot. Otherwise, it's better to be too early than to be too late. I think that luxury is only available to, a very few businesses that have very high return capital. You're sitting on some money because you raise extra money, but your business is not that profitable. You should still go public as soon as you can, because that will dry out.
Hello. Before we get started with this episode, I quickly wanted to share that we are now a part of the Zerodha Media Network. Thank you so much for watching. Welcome to the Indian Silicon Valley podcast. I'm your host Jivraj, and today I have with me a very special guest. Join me in welcoming Mr. Sanjay Kukreja, who is the Chief Investment Officer and Partner at India's largest PE firm, ChrysCapital. Thank you so much, Sanjay, for joining me today.
Thank you for having me here. It's a pleasure. I'm honored to be here.
Thank you so much. That means a lot. I'm very glad and thankful to Mr. Ashish Dhawan for connecting us as well, and very honored to be hosting you. I've always heard so much about, ChrysCapital, the culture, and how you've become, the largest PE firm in the country. You've been around for 25 years. You're $9 billion in AUM, and it feels like a massive success because you've also invested in some of the most legendary companies of our time: Infosys, Yes Bank, AU Small Finance Bank, so many others. I'd love to get a sense from you before we dive deeper into the PE mindset as to the broad investing journey that you've had, and the fact that Chris has been around for 2.5 decades now. What has that been like? What is the scale at which you are? And for those who may not be aware, just the context at which we are dealing, and then we'll go deeper.
Sounds good, and thank you for that. I think you set the context better than I may probably do. But just for, just to set the context, basically ChrysCapital started in 99, right? I joined shortly thereafter. Ashish was obviously there from the beginning as he set it up. A few of us were there, at that time, and it was, the fund got raised in 99-2000 time period, and that was fund 1 for us. We are now in fund 9, right? And it's been a journey of 25 years where we've continued to scale and grow. It's not been linear. We've had our ups and downs. We've seen cycles. We saw the dot-com bust. We saw the GFC, global financial crisis. We've seen the governments change in the middle. We've seen, more recently, not just COVID, but ILFS crisis and all of that through the period. And I think very proud, to create a, to be part of the story that helped create a track record, which I think, we're all very proud of. I think us as a firm, but also a lot of people in India are very proud of that, because it's really building an institution of size and scale out of India, right? Yeah. And that's really the passion, and that's what's driven us to reach this point. We're like I mentioned, 9 funds. Not many private equity funds globally have reached nine funds. We've also had a founder transition along the way. You referred to Ashish. That was in that 2010 to 12 period, and successfully the firm has continued to thrive and frankly continue to scale, and so we're very proud of what we've accomplished, while doing all of that. So that's where we are. We are India's amongst the oldest, largest private equity fund, and one of the most successful track records. So that's what excites us to create the culture that will continue building on this in the future.
Absolutely. I can imagine all the reports say that, ChrysCapital has successfully returned a lot of investor money as well, created a lot of stakeholder value for promoters, for LPs, and for folks within the firm. So I think that's very, very commendable, and lots to learn from all institutional investors from Chris. I think we want to dive deeper into understanding that mindset. How do you make that alpha in the market? Personally, I'd love to start off with the fact that, 25 years of investing is no mean feat, right? I mean, it's very, very difficult to do something like this, especially at a time when investing in India was not the norm. Like, a lot of people now talk about the India story. There's a lot of faith in knowing that, okay, India tech will be the emerging, economy growth factor. But what was it like in 1999, personally for you? How did you see the economy grow? And what has the PE mindset helped you bring in the last 25 years, if you can give some context?
Sure. So, look, I think, investing in particular was always a passion. Okay, it was a passion even pre-joining ChrysCapital. I think Ashish and I connected on that pretext, and we generally bonded very well together. Right, thinking about investing, it was a passion. How do you compound? Where do you go? And it was just an amazing journey. We learned a lot together. I learned a lot from him. We continue to build on on further. I think compounding in India has always been a growth story, right? We started liberalizing in '91. Personally, I was kind of looking around for investments from that stage onwards, and watching the the Harshad Mehta the ACC sort of play out, the '95 IPO boom play out, and then the MS shoes and those big IPOs that happened, and then the East Asian crisis play out in '97, and things sort of settled down, impacted India as well, and then the dot-com bust in 2000, 2001. But when we started ChrysCapital, the idea at that time was concept arbitrage, right? Was to say, listen, what had worked in the West, right? And Ashish should come with bright ideas of I know the West, I've seen it, Goldman Sachs and wherever else, and a whole bunch of partners and ideas, and say, look, how can we get these models to come and work here? And we very quickly discovered that the scale in India, particularly in those days, was just not there, right? We invested in a bunch of assets early on, which were e-commerce oriented, right? A few of them did well, Jobs Ahead, Igorukul, Bazi, at least those names are familiar, but the overall basket of what we ended up investing, there was probably 15 odd investments which successfully destroyed capital as an overall bucket, right? And probably we were working the hardest at that time of all the 25 years that we worked. Every day was like till 2 a.m. And in hindsight, when you say if you had just stopped back and taken a big nice vacation, we would have lost less money than kind of do what we ended up doing. But I think it taught us a few things. It taught us to pivot. It first of all taught us more than anything else, to approach a market when the scale is ready. And the idea, in those days I remember we used to target, 1 million customers to 2 million, and we had projections of how quickly that will go to 100 million. But internet users in India didn't scale up to more than 3, 4, 5 million, and this petered out back then because, lots of different constraints and so on and so forth. So we'll delve into these later, but we pivoted from venture to private equity, and I think that was frankly the the major pivot that we made in our lives. And
which year was this?
Pretty much 2002-3 onwards.
Got it.
And I personally led that pivot because I had come a little bit more from the the Buffett and Graham and values style of investing that I had sort of worked on, and here was the VC quick investing and all of that I'd come to. And so that didn't, this worked out very nicely for me. And it was my comfort zone was always in value investing in private equity. And then we did the first investment I remember there was, SpectrumMind, which is a business services company, which we ended up selling to Wipro, which frankly saved the fund, right? That one investment returned the fund, which was our fund one, $60 million fund. And then we had, in that fund, we also had UTI Bank to Axis Bank, which is in financial services. So we took a very different call. I was, on point on that transaction. Very, a great sort of transformation happening from a sleepy, old private PSU bank type of institution to the new age institution that it's grown on to be. And we were very fortunate to see that transition and play a role to some extent in that journey. And so thereon, that was the beginning. And then the next 3 to 5 years was just, after that because on the back of the returns, we were able to raise a second fund, which was about 120 million. That was also when we institutionalized the firm in some ways, right? We had Harvard endowment come in, Stanford, endowment come in. So university endowments came in as opposed to faith capital of original, typical partners investing behind you. And that really helped, scale the institution. And then fund 2 and 3 in particular was just, I don't think India will see a better performing fund. That fund ended up delivered a 5x, but more importantly, 100+% IRR. It was, that period, 2003 to 7 was just, didn't matter what you did, everything turned out to be, in hindsight, everything turned into gold, right?
Which were some of the companies in that fund?
I mean, you had, Shriram Transport returned the fund. It was a $20 million fund investment that returned 250 million plus. It was a 250 million fund. We had Suzlon in that fund. We had Intas in that fund. We are still investors in Intas, right? The Intas, I think, investment was made 2004. It's 2024. We're still, in different formats. We sold over the years through one fund to the other, etc. But
Mankind was also 2006.
Mankind was 2006. Yeah. So we've had so pharma and healthcare has been a big segment for us, right? The 2003 to 7 period was just everything, really, really hit the ball out of the park. Not just for us, I think broadly as well. Of course, we did well. What differentiated us actually was the exits that you talked about. I think, we didn't wait until 2008 crisis and everything. And I think some of the, the marks that were hit in 2007-8 weren't hit till 2015-16, right? And so
that would have made a massive difference for folks who didn't exit.
Yeah, and so it depends. So your taste of India depended on when you came in, and unfortunately, a lot of the institutional investors that came into India came in the 2007, 8, 9 vintage, because that was when people started to take note. I think Warburg had this large Bharti exit, which was there. We had some of these marquee exits. Shriram Transport, Suzlon, each of these kind of returning 250, 300 million. So people took note. By 2007, all large global private equity funds had already come into India, started to set up their own, private equity shops. And we had global financial crisis hit us, right? And that, interestingly, some of the biggest mistakes actually were not made for us personally, not made prior, because we exited most of what we needed to. Prior to the GFC, but we made some of our worst mistakes in 2009 and 10, post the global financial crisis, where we backed what we thought was we were buying some of the companies that we had already made money on in the first time around. We thought we were buying them cheap because now the valuations had come crashing down and margins were lower, but we felt like how low is low, right? And you're buying these at 5 times earnings, 7 times earnings. Eventually India is going to turn around. And what happened, in fact, was this was the policy paralysis phase, I would say. That's the term that people use, 2009 to 12. You saw delays in, delays in commissioning of projects, debt sort of generally ballooned in the system, and you had a full-blown sort of banking, crisis playing out, right? NPAs sort of ballooning and all of that playing out. And so some of the companies that we bought really cheap at 5 to 7 times earnings, 9 times earnings, stayed cheap. And not only did they stay cheap, the leverage increased in those assets, clearly thereby destroying equity value. Right? So knowing when to exit is also actually a very important art.
Absolutely.
In fact, I remember a conversation with one of Ashish's mentors who visited us from the US, and this is a fellow who had, built a whole private equity firm in the US. This is George McCown of McCown Delu, and he was visiting us, and I remember asking him the question, look, investing I get, I've figured it out, 8-10 years, been doing it, etc. Buy things cheap, buy a good asset. The hard part is exiting, right? And when do you exit these? How do you exit companies? And do you do some complicated IRR math, saying incremental? That's where I was going with it, right? When is the incremental IRR? If it's beyond a certain point, when do you decide to pull the trigger? Because all these businesses are compounding and growing, continuously. So if you continue to hold, you'll end up doing well. And, I was expecting a real, well thought through, articulated answer to help me calibrate and understand it. And George goes, my experience with exits is when you get him, you take him. I was like, okay. This point was, you don't always get exits. And so, when you get them, you should take them. Because you never know when, if you're going to be in the position to take them. And this was 2007. And, in hindsight, obviously, it was the peak of the market and, great words of wisdom at that point. Yeah. Another great sort of nugget that I've picked up on this is, when you think about timing the exit, right, which is what most people struggle with, right, and you've got to figure out, there are only three sort of possible outcomes, right? Either you're going to sell exactly right, right? Or you're going to sell too early, or you're going to sell too late.
Yeah.
Right? And that's what I tell myself, right? Either you believe you can sell it, on the hour, on the dot. Otherwise, it's better to be too early than to be too late.
Yeah.
And therefore, if you're leaving some money on the table, it's okay. It helps build your brand. Other people also end up making some money, but you'd rather do that than to sell too late. I think those are some of the things we learned along the way. And then we continue to scale. One other pivot I just quickly talk about is 2010-12 period. When post the founder transition, we also moved a lot into control deals. So in our first decade, I think we had less than, it was almost nothing, right? Which was control. Maybe some early stage VC, which ended up being more than, a minority stakeholding because of whatever, but it wasn't control in the way we understand control deals today. But in the last decade, more than 30% of our capital has gone in control deals, right? Where we own control deals are where we own sort of majority, 70, 80%, if not 100%, and therefore are in a position to drive change in the organizations ourselves. And that needed a big DNA change, right? In terms of how we're going to handle it, how we, do we have operating skill sets within our, not just investing skill sets, and how do we create, value in the companies that we invest in. And that's helped us become better minority investors as well, because we've sharpened our operational value add, capabilities and competencies. We've created an in-house team called Enhansen. We'll talk a little bit more about that and all of that. So that's one big other pivot that we've had, to the point that in our last fund, which is Fund 9 now, as we stand, we have more than 50%, like almost 60% of our capital right now being in control deals. So it's a very big pivot that, we have seen, but India has also seen. So lots of founders willing to sell, their businesses. A lot of, in your world, as you talk to people who are sort of very passionate about setting up and you see the excitement about setting up businesses, there's also equally another set of folks who are willing to, sell their businesses, go overseas or do whatever else they have to enjoy retirement and be happy to, let somebody else run with their businesses, which was not the case in the India that sort of we started investing in. Right? And just overall, I'd say competition has changed. The flavor of competition has changed dramatically in these 20 years, 25 years. When we started 99, 2000, there was at that point already 100 odd, VC funds. And almost all, most of them didn't, make it beyond 2002, 3 because that vintage,
100
returns.
funds then?
Back there used to be something called E-Tuesdays in Bombay, E-Sula. There was this whole, this big new economy, advertisements were all being driven by hoardings for the new, India and all of that used to be there, right? But there was a whole ecosystem, a very thriving ecosystem that got created and then disappeared within 2 or 3 years, very, very quickly. I think Westbridge, us, few others survived, but a lot of them, other folks, didn't. And I think track record is a good, differentiator which allowed some firms to succeed in. And how, frankly, more than even track record was how quickly could they raise the next fund. And if they were around to stay long enough, they could to survive and live to fight another day, right? As they said. So, Fund 2, if we hadn't raised in time, we may not have survived. And so I think that also helped quite a bit. So yeah, I think these are just broad thoughts. I think the one other thing I'd say is so just on competition. Sorry, I'll complete the thought on competition and then exits. Remind me before I forget. We've had other homegrown companies develop over time, but then the global fund, the global PE funds like the Warburg was already there, but Blackstone, KKR, a lot of these other folks came into India. The top 10 of the world sort of came into India, and so we as homegrown, private equity firm also needed to sort of gear up showed up for competition, deal with that. So that 2007-10 onwards was one level, but I think coming to 2015 and 20, it's a completely different level because most of these global funds have also raised Asian pools of capital. And that is pivoting much, much more into India. Right? Almost 40-50% of the capital is coming to India. And so you're competing in some ways, but also they're, also a larger deal size than us, and so it almost provides another layer of liquidity and exits from our perspective as well. So we build good companies, then we find and other sort of, other than just taking the companies public or strategic investors, we also have global private equity funds willing to, we've partnered with them in some situations, EQT, for example, in HDFC Credila. So we've dealt with competition over the years, and the flavor of competition has changed. You've also had AIFs come in, right? And pre-IPO funds come in and copy and say, listen, whatever Chris term sheet on the table, I'll Chris plus 10, Chris plus 20, deals yours, deals ours, and we had to deal with that, that as well. So flavor of competition has changed quite a bit, but I think in general we've been able to, as long as you sort of stick to the knitting, do the right things, you have your own, base of surviving and building a, good business. And then finally, I'd say exits. We've seen the flavor of exits change. So earlier we were selling only to large, taking companies public, and then selling to the global institutional, investors in the public markets. So like the likes of Capital Group, T. Rowe Price, Fidelity, those were our traditional people who bought out our stakes in Shriram Transport, in Suzlon, in all of these companies. I think that's pivoted dramatically today because domestic savings has, has increased in India. HDFC and ICICI, and these have become large institutions with, heft in the market. And so I'd say our exit to foreign capital, which was like 80-90% of our exits, is now maybe down to 20-30%. And it's largely more, we're selling to public companies, to in the public markets, to domestic mutual funds, right? And they've also seen, good track record of things that they've bought from our stable, and that continue to do well. And so we created a little bit of a brand with them as well, and that's also helped.
Wow, this is, I think,
covered a lot of ground.
Yeah, covered a lot of ground and a lot of fascinating insights. Goes to show the importance of maybe just building just such strong track record. I think it's very commendable how to grow an institution from scratch, have its own credibility, and also, despite the competition from some of these larger players, really have your footing. So I think it's very commendable. I have so many thoughts, but I'll probably try to break it down. I think one of the things we keep hearing is, what is the and it's also a bit opaque, is what is the LP narrative in India, right? And a lot of these global funds will anyway attract and have their own capital pools. For somebody like Chris to, grow AUM significantly from a 60 million fund to, I think, your last continuation fund that you announced a couple of weeks back was about 700 million, you now at 9 billion AUM. How has, the LP side been impacted, and what has that flavor been? Like, has the India story been as confident? Has there been more wave to it? Has there been a push to the early stage venture? Because, we've seen a lot of noise around early stage venture and how that's done well. We have 110 unicorns, and that's the side I'm also more used to. But what is the LP side of the narrative? We barely get to hear that side of the story.
See, the LP narrative, like I kind of briefly covered, right? It's not a constant, there's not one LP, right? There are different people, and I think the narrative is very different depending on the vintage in which you came into India.
Okay.
Right? So if you talk to the likes of Harvard and, GIC and all who've been investing in India for a long period of time, have seen the cycles, have, made a lot of returns, with us, elsewhere as well, other funds or direct investing as well, right? And so they'll be very happy and, would have seen great returns, right? Yeah. If you came in, first taste of India was 2007-8. I think that was the piece in which people suffered because your IRR wasn't great in that vintage, and returns didn't really come till 2018, 19, 20, right? And so a lot of folks then saw re-upping behind same manager with different funds, and literally no liquidity coming out from the different funds. And so there was a long period of time where we had to deal with that, so it wasn't just selling why ChrysCapital, you had to sell India story, right? Yeah. Because even though we could argue that our track record was good through the cycle, etc., and all of that, but the narrative was that, listen, my India portfolio isn't doing well. Yeah, why should I, bother with India, given I can get, great returns elsewhere and, other parts of the world. And there were different, different points in time, different things have been, relatively hot that we have to deal with, because they become the flavor of the story becomes a lot more, compelling than the, the track record, right? Because track record in itself is not a compelling story, right? A compelling story is the future, the prospect of making great returns. And we've had some point in time, venture, right? In 2007, 8, 9 time, becoming really after Flipkart's initial deal and setting up and all of that. And also, again, 17, 18, 19 period, right? Becoming really hot. Yeah. And some of the endowments decided to say, okay, we'll either do publics in India or do venture. Why do private equity, right? And so all of these narratives we had to counter, right, over time and deal with, listen, we have a consistent story, and a consistent track record, and this is the opportunity, and we're going to stay, true to the knitting. Yeah. People who lived through the cycles, have come to appreciate that. Yeah. Right, and I think that's what values are, right? And you can come and demonstrate that through behavior. Mm-hmm. I think this business is a lot about, ultimately, I feel like, the private equity business is the ultimate business of trust. Yeah. Is people in other countries, don't understand India as well, right? Are, parting with their hard-earned wealth in some form or the other, and with full discretion what to do, right? And expect a return after 10 years. It's a 10-year life, right? You really have to have, trust, and therefore the feeling of trusteeship, within all of us to say do right by the investor is the most important thing, right? And if you do right by the investors, particularly in bad cycles, over-communicate, this product has high fees, this has all of other things, elements linked to it, which can cause a lot of misalignment with investors, and so you have to work extra hard to make sure that alignment is right, communication is right, and you do the right things, right? And then over time, as the track record plays out, you come out the right side. Absolutely. But the temptation is always there to, okay, why are the FOMO aspect of it? Why everybody else is? I mean, we started life as VC, right? And we were there in 2007, 8, 9 as all these different new age businesses were raising, Series A, Series B, Series C in front of us, and 10x higher and 20x higher, and it's like, these are companies we know, and it's very easy to get tempted into saying, look, let's try this out, right? Let's figure it out and all of that. And what we said was, look, listen, we're gonna, if so much money is flowing into venture, somebody else has the better skill set to be able to scale up and build these companies, right? We're going to come into it when they start resembling private equity type risk reward, right? So we're going to sit aside patiently, wait for some of these businesses to get profitable. We will be the providers of capital that can help them go public, right? And help them, change their lens of direction from a VC-led model where they're experimenting on 20 different things to try and see out what works, to be to focus on those 2 or 3 things that are really important, and then scaling the business from a growth point of view where everything works, right?
And let's maybe talk about a bit more on that, because a lot of narrative around, okay, VC businesses have more abstraction, there's more qualitative data, you don't have as much quantitative data, you have more qualitative factors. So the PE mindset is relatively different. There's more optionality. You also are going after larger pools of capital for more concentrated periods of time. If you had to just quickly highlight differences in style of investing when it comes to venture vis-a-vis PE, what would that look like?
Okay, I'll give you a anecdotal story, right?
Sure.
Which will probably summarize it, and probably it's an unfair comparison because sign of the times.
Sure.
But I remember, pretty much in my first, week at work, right? We were at that time doing early stage seed, venture, and I was in a meeting with the founder, right? And Ashish and I were there together having a conversation with the founder, and 1 hour into the pitch, discussion was going on. Ashish threw me on the deep end saying, I was just in, and he's like, listen, Sanjay, what do you think? How would you value this business? What do you think is the value of the business, right? And the entrepreneur sitting, it's not a one-on-one conversation on the side. It's my, literally my first day at work, and we're having this conversation. And, so I look at him and politely, nod and say, I'll have to think about it. I'll have to do analysis, and, I'll have to figure this out and look at this 3 different ways, which was my style, right? Which I kind of communicated earlier as well. And then Ashish turns around and says, by that time we'll be like dinosaurs, right? we'll be all dead. You have to come with a decision now, right? And so he was pushing me to come with a decision right away. And then we signed some term sheet, right? In the
Wow.
in that conversation, signed on the Times in the 1990,
This is 1999.
early 2000s,
Yeah.
right? And we put some numbers on the table, and we just went with the meeting with the term sheet, right? Back in the day. I don't think we knew much about what we were doing. I'm sure today's model is much more sophisticated and different from that point onwards. But just to contrast it, right, as a fund now, right, post in the private equity world, we probably look at about 150 to 200 NDAs, non-disclosure agreements that we sign every year, right? And we probably do 3 to 4, right? We've done 100 investments in our existence
years,
in over 25. So it's 4. It's broadly equates to the 4 a year, right? And we would of that 150, 200, probably deep dive into 50 of them, right? Where we're doing proper diligence, spending money, figuring out, maybe spending 2-3 months sort of doing deep dive engagements with these companies, etc. We do 25 investment committees, right? Maybe look at 15 things that get approved by investment committee and maybe close those 4 out of that, right? So it's a proper funnel, it's process, it's discipline, it's a system that works. We've built it over time, right? It's no one individual can change the narrative around it. It's an investment committee approach. It's a it's a business of apprenticeship. You learn it by being with others over time and cycles, and we've been very fortunate to have longevity as a culture. Maybe we'll talk about that's another theme that we can talk about. But yeah, I mean, it's they are chalk and cheese. I mean, as at least what in terms of another good way to think about is what is loss ratio, right? In VC world, I think, or seed world, if you're doing 50-60% loss ratio, it's a pretty damn good outcome, right? Because others, the ones that are doing well, will actually end up doing really well, right? So you got to be comfortable, right? Knowing that more than half your businesses will actually go under or not give you any return, right? And knowing that you were equally bullish or equally excited about each of those opportunities, otherwise you wouldn't have invested behind it.
Yeah.
And then wake up the next day and be equally excited about the next opportunity that comes in, right?
Yeah.
So it's easy to do that when you haven't had the hits.
Yeah.
It's very tough to keep doing that cycle after cycle, right? And wake up and say, okay, I'm going to keep doing this. That was not for me, right? For us, a loss ratio is like 7%. And that 7% broadly exists in that 2009, 10, 11 vintage that I talked about. For, some of those other lessons of buying cheap and all of that which you learned, and incrementally we think the loss ratio is going to be even lower than that, right? So every time you make an investment, you're trying to basically there's a risk appetite. You have it's pattern recognition. You understand the trends. You figure it out, and you get better at it over time. So so you work with a very different loss ratio. You work with which means the time spent in diligencing, figuring out eliminating those risks that you've suffered in the past, and you make sure you kind of don't get caught into those, right? And there are lots of those risks that you kind of go through.
That's super fascinating. I also think you don't play in the tails, right? You play more in the means, and I think with VC you're playing so much in the tails, and there's so much of a luck component that you can never time as well, perhaps, and that becomes a part of abstraction. But very interesting. I think these are very, very crucial learnings. Would also love to know, you briefly touched upon this, right? Value add is almost like overused term in the ecosystem now. A lot of early stage investors also try to justify value add. When it comes to a PE investor, that value add is very hands-on and perhaps very operational, especially for more so control transactions that you mentioned about. Can you talk to us about more in tactical terms what it looks like? I mean, for somebody who may not be familiar, how do you as a firm perhaps add operational value? What does that look like? What is the preparation on your end? Because fundamentally you're trained to be investors perhaps, right? So how do you build the other skill sets, and which are these companies that require perhaps the operational support, and what kind of support? So I think that will clarify a bunch of things.
Sure. It's a good point. And I think what we've tried to do as a firm is also when you stand for a certain level of understatedness, a certain level of undercommit, over deliver, right? I think that's just values we've grown up with, and
it just transfers over a period of time.
Builds over a period of time, and therefore we hesitate to use these,
fancy
words, right? Say, oh, we will transform your business, or we will do something dramatically and differently. And initially we used to struggle a lot with it. In the first decade, I would say we'd even go out and say, listen, we will add value only in the one or two things that you want us to. We are backing a great business, right? And we trust you to do what you're doing, right? We will be part of your journey. We will help you. We will be a sounding boards. We will be available, right? But we're doing at least while going in, right? And people would make all kinds of claims that we're going to take you global. We're going to do this. We're going to do that, and all of that stuff, right?
How do you survive like that in a competitive environment?
Exactly, in a competitive environment, we'd call it out. I think people are smart.
People appreciate authenticity.
People appreciate authenticity. People appreciate what are you doing, and how you're building it out, and all of that. I think for us, it really, we were always focused on the sector, right? So we weren't broad-based from the beginning. We started with IT. Back into emphasis, we did 2001 to back in the day again. The transaction that I'd worked with Jerry Rao's company, that time $60 million business. Now, of course, much larger. But we were there all the way till I think when they ended up selling to EDS or whatever, right? So scaled up from 60 million to maybe 300-400 million in our journey, and then we made a very decent outcome return on that investment. From there, we built our IT practice, included the likes of Infosys you talked about, but it's CL Tech, KPIT, Scient, a whole bunch of other. So what we figured is learnings get cumulatively built over time. Sure. And what we were doing is we were covering these companies. The same team was actually going meeting companies over and over again, right? So we had that sector specialization approach from day one. I think today it's become a lot more talked about and commonplace, but back then it wasn't. Sure. And we were sector first by design and from the beginning. The danger with being sector first, of course, is that everyone wants to do the sector deal. And how do you, there'll be points in time when a sector, it makes sense not to do the deal, any deal in the sector. So how do you deal with that?
Yeah, you have to be with evergreen sectors all throughout. I think today morning there was an ET article by, I think, Chris itself on healthcare and pharma, if I'm not wrong. So correct. I think, that's also a
moving towards a little bit more towards buyout in that area. But pharma healthcare has also been a
major focus.
Major focus from us. Back again from 2004, we had Sanjeev come in over time from Ranbaxy, and then built that practice for us. We had in financial services Ravi Behel. I'd worked with Ravi, together, more me on the investing side, Ravi from the operating side. Together, we put together, and then eventually both of us were joined at the hip in doing some of these, phenomenal transactions. Bajaj Finance, Mahindra Finance, Shriram Transport, AU, more recently Hero FinCorp, and obviously Ravi is now no longer with the firm. More recently, other investments as well, right? So sector specialization allows you to have the knowledge, the network. Over time, the network builds, and so then you're able to say, okay, can I bring, if I have to think about a company, can you augment its board? Can you bring C-1, N-1 talent, CXO suit, CFO? A lot of those things are something that you can just hire from market by search firm, but if you can bring your own network to bear, right? And people you worked with in the past, it's actually, you have a lot more comfort. You already know the journey, strengths and weaknesses. So that builds over time. You can't do that right away. You can't
short-circuit it.
Where we are today versus what we were, say, 15 years ago or 10 years ago, it builds, right? And so our claims have also built over time, right? As we've gotten build our network. Now we've done like 25, 30 IT services companies. We've seen probably 15, 20 exits. So, in each of those, there is a management team of 8, 10 key people. You see, and that's a network of 80, 100 people that we have worked very closely in the trenches with, who we can bring, or at least have the ability to pick up the phone and have those conversations, and really guide the next situation to actually make lesser mistakes, right? So how do you think about navigating the next cycle? How do you think about how the cycle may be changing? I'll give you a good example, right? Back in 2010, Salil, who used to run Capgemini back then, now is CEO of Infosys. Was a good friend, right? And part of our network. And, I was having this conversation with him saying, listen, what are you planning to do? HCL is that time 40, 50,000 people. These guys are already 20,000 people. Right? And they're saying, look, I'm going to scale to 1 lakh, and IBM was already 1 lakh. And, there's massive plans to build out, back in India, businesses by the global captives. And to me, that, that from that conversation, it was pretty clear that, you're going to have commoditization of Indian IT services on just pure labor arbitrage. And so to navigate through that, you needed to come up with a different, the HCLs and the investments that we were making in the past may not necessarily survive. And you needed to back a different breed of entrepreneurs and a different breed of companies, right? And then we didn't have the network to do that. And that's when we went scouting in the US, right? In 2012, we found Liquid Hub, right?
And
said,
listen, a 500 million exit to Capgemini.
To Capgemini, right? And Salil coincidentally was on the other side, even then playing the, the takeout for that. So your network always comes to play one way or the other, right? But even guiding to where to invest, right? And then how to build. It wasn't as if Liquid Hub was already a digital, the word even wasn't coined at that point in time, right? So it was a front-end shop, which was not the conventional wisdom. I think the ability to be one step ahead, to think of what's the next wave, and how do you play for that. I think it was pretty clear there that the next wave is going to be front-end, closer to the customer, tech, digital orientedness without knowing what was digital at that point in time. Enterprise architecture is how we defined it. And then we had to build those capabilities organically and inorganically.
Sure.
Right? So that's when we could use our network. And they were all, so for example, when Liquid Hub came in, they said, listen, can you help us build India? We don't have India. We have a very small, like 8% of our business in India. We don't have anyone here. You guys are from India. Can you help do that? Then sure, we can do that. Right? Sure. So that was a classic example of saying, look, something that didn't exist, we could build the back end for them, right? KPIT was another transaction listed company. They didn't need our capital. IT services businesses, frankly, don't need much money. I often say we're in the business of providing capital to people who don't need capital, right? And so I'd rather be in that business than, to be providing capital to capital-hungry businesses, right? And which means, therefore, either I'm going to find M&A opportunities, or I'm going to find and be okay with secondaries, right? Giving exits to founders and all of that. In KPIT's case, we had to find an M&A opportunity. Sure. And so that's where it came together. The M&A opportunity they were looking at, we had looked at in the past. We were able to guide them through that journey and figure that out, right? So work through that. Over time, in our portfolio companies, we've done over 50 M&A transactions.
Wow.
So
within the portfolio?
Within the portfolio, right? So now there's a muscle that's built over, what is the right M&A? How does it fit? You don't acquire just for revenue. You don't acquire just for scale. You acquire for capabilities, competencies, aligning with the management, what's really needed, how do you build that? How do you work with a project, monitoring team? How do you integrate? When to integrate, when not to integrate? How do you structure earnouts? Lots of different questions, and things, thought processes behind it. We've navigated that. So M&A and capital allocation is one area that I think we say that, listen, we've, by virtue of doing this for 20 years or 25 years, 200 sort of looking at various different businesses, we probably have a better handle than, some founders who may have done a few of those but not have the same depth of expertise. And they're very happy to actually let us play that role, saying, listen, why don't you scout for acquisitions? Why don't you? We have actually in our team a global head of M&A.
Wow.
Just does that on a full-time basis. Only job is to scout for M&A transactions for our portfolio. And they have to be, niche, smallish. We're not, in none of these situations are we taking a, bet the house kind of an M&A, right? Some of the big M&A that catch your eye, right? So people have gone and bought very, very large transactions that haven't worked as well. We're buying 5-10% of them, which don't really fully swing the needle. Sure. But cumulatively add a lot of value to the returns that we've generated. So M&A capital allocation would be one big aspect of it. We have a team that we've now built. I think particularly since we moved to doing control deals, we figured we needed more than just advisors. Of course, we built our same advisors, and and we should talk a little bit more about that as well. But on top of that, we built a team called Enhancin, right, which was essentially our own project management team. So these are people who worked in Alvarez and Marshall, operating skill sets or consulting skill sets, right? We have 9 folks right now. We started with 1, 2, and then kept adding. Organically, it built over the last 5-6 years now. Journey's about 6-7 years, right? And this team actually is fully employed by ChrysCapital, their ChrysCapital team. But it's a service we provide to our companies, right? And we don't charge for it. They run projects at companies either directly, or they would bring point solutions or other consultants and be the tool that actually, be the project management tool that actually runs these at our company. So
Very interesting.
we, at the time of making investment right now, we would typically have that conversation with the entrepreneur saying, listen, where would you like us to get involved with, right? And we align with what would that look like. And sometimes the answer is like, look, we've got our business, we understand this as is, right? But we need help in, these 3 areas, right? Maybe new territories that we're adding, maybe we haven't figured out cost optimization, maybe our supply chain isn't figured out, maybe our tech isn't figured out, maybe our digital isn't figured out, right? So we figure out those areas, and then we put, a team of 2 or 3 people from this team that actually run continuous projects on to help them, execute those specific projects. On top of that, we have, of course, our deal team, which has gotten some capabilities now after spending the years, looking at these various deals, to be able to add value, ask the right questions, and push the companies in the right direction. On top of that, what we're trying to do is also have on the boards not just people from investing skill sets, but a typical operating advisor from the industry of which the company is coming to. Somebody you may, appreciate or
and this is from within the team?
Not within the team.
Okay.
This would be
external advisors who are operating experts.
Who would get them to have skin in the game.
Got it.
But run projects for us. But we have a roster of advisors.
Sure.
Right? So when I do my reviews on sectors, for example, we're not talking only, what's our deal pipeline. We are also now talking what is our advisory pipeline. So who are the advisors we could bring into a company day one? And since we're doing transactions on control deals, we also are talking about what's our CEO pipeline. Right? So who could we bring in, if you're buying a consumer brand or a, a financial services asset, who could we bring in day one? Right? And that's something that we are not discovering post-fact, but having that
during
together.
The diligence process.
So I would basically saying talent enhancement, right? M&A, right? And then very focused enhancing projects linked to supply chain management, linked to cost optimization, linked to revenue acceleration even. Certain times it's like finding new markets and new customers. Very specific projects that we work with our companies, right? We'll still not make a claim that we'll transform your company and do something completely, different. But we have now seen that we are, able to make material delta in some of the companies that we've invested in. Many of the companies that the talent refresh that we've had has been of the order of between 5 to 20 people in the companies that we've actually invested in, because these are larger companies. And, and I'm talking N-1, N-2 as well. But a whole bunch of, sometimes CXOs as well. Right, that we've been able to bring.
Very fascinating. I think this is, tangible value addition which shows in companies. And as you mentioned, I think a lot of it gets attributed to focus and concentration and network effects that you've been able to curate over a period of now 2.5 decades. But it's really commendable. One interesting thing, Sanjay, you mentioned is, you give capital to companies that may not need capital. And part of it is also the dream of IPO, right? A lot of what a PE ends up also contributing to is making a company IPO ready, helping out with the process, running a diligent perhaps stream during when this is happening. And I think you've seen more than 15-20 IPOs now in the portfolio. There are a couple lined up as well. Office, First Cry, etc. Are a part of the portfolio which are going live. What is your learning from an IPO standpoint? Like, what does it mean to genuinely be like IPO ready from perhaps a founder standpoint? So many founders on day zero perhaps think of ringing the NSE bell someday. How does that happen? What is your experience teaching you about IPOs?
That's a great question. The overarching comment I'd make to everybody aspiring to take a company public is please treat that as the start of a journey, not the end of a journey. Right? I think that is the that's the start point where things start to go wrong in the first place. I think so many entrepreneurs think of that I'll go public only when everything is done in my business. Right? It's fully baked. Everything is done, my company is running absolutely smoothly. I have predictability for the next, 5 years and whatever, right? I'm exaggerating to make a point. But that never happens, right? And so it's a journey, right? The question is, who are your stakeholders in the journey? And I think it helps to have, retail shareholders as part of your journey, institutional shareholders, or broad-based shareholders as opposed to necessarily just institutional investors. There's a role that institutional investors, private equity folks like us play in the journey of a company. I think beyond a certain size and scale, it helps to have a more broad-based, base of shareholding, which can help create more sort of ESOPs, value, all of that. So the case for going public is actually quite strong, particularly if the business needs capital.
Sure.
And has M&A aspirations and ability to raise capital is just that much easier.
Yeah.
If the business doesn't need capital, sorry.
I might just quickly interrupting. I think the broad narrative in the US and India has also been that considering late stage capital is now more available, considering the zero interest rate phenomena as well, right? Companies are perhaps staying private longer and going public later in the cycle, right? And as you mentioned, there's this fallacy that you have to be completely ready, which you'll never be. What is the thought on that, and how does your business model get impacted by it?
So look, I think if a business, is a fantastic business, generates return capital, there's no need for any primary capital at all. Mm-hmm. You can argue why should it go public, right? Because if the founders don't want to sell, right? And private equity is like a small, tiny piece of it, right? Eventually, people may argue that, listen, as a founder, this pertains to minority investments. Control, you can do, what you want anyway. But in minorities, right, a founder may take a view that, listen, I don't have to face public scrutiny. I don't have to be answerable to anyone other than, one investor or two investors. And therefore, I can navigate shocks, any challenges much better in a private manner. Right? If I have, regulatory issues, if I have any other issues, I'm not sort of, very exposed to in a very public way. Mm-hmm. So if I can keep it private for longer, why not?
Sure.
Right? And therefore, but I think that luxury is only available to, a very few businesses that have very high return capital. And therefore, if you're like, if you're sitting on some money because you raise extra money, but your business is not that profitable, you should still go public as soon as you can, because that will dry out at some point.
Sure.
Right? When you're in that position, you can ask that question. But even then, I would argue that if you truly want to professionalize and create a business that lasts beyond the generation of the founder who is in, you need to be able to, follow that path. And there isn't anything better than public scrutiny and the ability to, go through the fire, trial by fire to actually do that, right? That will allow you to actually do that. So I'm in the camp that companies should go public sooner rather than later. That being said, there's a lot that needs to happen. Predictability is important.
Yeah.
Business model. The biggest thing is, I think, public markets will probably not, so VC world. So if you think about risk appetite, right? There's the VC world, there's the PE world, and then there's the public world, right? And it's a declining curve.
Right.
VCs will give you everything, right? Saying, okay, you go build. You have to go from 1x to 100x. You do what you have to, right? I'm exaggerating a little, but you'd want to go markets, different vectors, try and build the way you'd like to.
Absolutely.
Right? Our thing would be, okay, let's boil it down to 3-4 key initiatives that we won't say do 0 experiments. We'd say, your core business is your core business. Let's run 2 or 3 experiments. Let's try and do something, maybe one new market, one here, and let's agree on how much capital we can, and it's a limited pool of capital, and let's just keep it at that. And for that, we'll be willing to say, okay, let's, we'll put some money and we'll probably do M&A or do something else to experiment on those things, right?
Sure.
Listed markets will have 0 tolerance for, large or failed M&A or a failed, where you have predicted profitability and then you come back into losses, etc., and all of that will not be taken kindly. So you have to have some predictability in your model, and your businesses need to have certain scale. So if you are like, one really good business with 3 businesses that are losing a lot of money, etc., you need to put it into some form of bonds, bound, and say, okay, I can still go public with assuming a story, and then stick by that.
Yeah.
And that is the role I think we play in the later stage VC-backed companies, to say, look, we'll help you navigate that.
Yeah.
And that resonates well with the people who want to go public. It's self-selection.
Yeah.
It won't resonate well with the people who still want to experiment with the 20 thing.
Yeah.
They won't be happy, we won't be happy.
Right.
So I think our narrative out there is pretty clear.
Yeah. And to that tune, like, what is your thought on new age companies being able to adapt well enough for like the public markets? Because we've seen a couple of them now. Zomato's a great story to that tune, where they've been able to, really respond well to the public. They've grown significantly since they've gone public. But do you think, the new age companies are built in a way where they are becoming retail ready? What is the thought there, and what do we as an ecosystem need to do to make it perhaps more ready? Also, the retail investor will they come to tune in saying that some of these companies will take some time even after they go public to get to the profitability standpoint, and will that change in the stock market really happen, or do you think they will always prefer more predictability, stronger cash flows, profitability?
So I think it's a combination of the two. I think retail investors in India still will have appetite only for when things are reasonably profitable.
Sure.
Right? There will be market cycles at points in time when the stories will become very, hot and exciting, and then for few opportunities will come, and then, no lessons will be learned, and things will, if not delivered, will go down in a certain way, right?
Sure.
But overall, the amount of capital that's gone, the culture of entrepreneurship that's there in India, the number of startups that are being built together, there is a funnel, and there's some very good talent, and then now there is size and scale and the cost and the bandwidth that allows for some very good businesses to be made and built, right? So I think it's Schumpeter, right? It's capitalism at play.
Yeah.
These folks will come and attack the old profit pools, and some will really win. And when they win, folks like Zerodha will emerge, and others will be really profitable. Dream Sports, right? They become profitable businesses,
sure.
And come out in which will be businesses that we could look at, right? And say, look, this is underwritable, and frankly, the Indian public investors would love those types of businesses,
sure.
right? Those will be the businesses of the future, right?
Absolutely.
So there is a play for that. I think Indian savings is ready for it, right? There is a big savings pool. Keeps, how many times will you keep investing back in the same sort of, same companies with no alpha? You want to try and get better companies which are growing faster, doing certain things differently, right? So the Indian market also wants those opportunities. And so I think that will happen. But I think the companies will also get a lot more, mature in terms of figuring out when to go public.
Sure. No, but that gets us to an interesting point. A couple of your companies in the portfolio are also, new age companies. You have Lenskart, Office First Cry also preparing for the IPO. They've filed their DRHPs. What is the sense of, backing some of these companies? You also have like Wow, etc. in the portfolio. If you can talk through some of these select, perhaps, transactions, how do you look at them? And now that they're going public, what is the, significance or alpha that you have been able to see in terms of, being private and now getting ready for the public journey?
So I think, again, there's a certain set of companies that, appeal to us, right?
Sure.
Take Office, for instance. While it's new age, right? I first met the entrepreneur Amit here when they only had about 2,000 seats, right? And then in a matter of a year and a half, it scaled to 16,000 seats, right? So you could see that, before doing the deal transaction, that they had, so many centers, each center was profitable, right? The model was one where, it was designed to make a very decent return on capital. It was very it was very private equity-like. It was underwritable, you could see it. The question was how many models, how many centers are you going to, how many seats are you going to, go to, and how many centers are you going to grow to? And we could do that math, and we saw that the opportunity was there, right? The real value add between what they were bringing to the table and what the real estate guys aggregating the demand. Nobody could aggregate demand as fast as these guys could for the target audience that they were serving, not the top end of the market, but the middle end, right? So, a very differentiated play, and it's continued to grow. Of course, was hit by COVID. And we went through a down cycle post that because nobody was going to work. So Office, of course, suffered in that journey, but the bounce back was equally strong. And you had your own pivots and models that you had to deal with at that point in time. But yeah, that opportunity is very large and continues to be very exciting. The beauty is it's a capital light business, right? It's a structure where you're not putting too much of your own capital at risk, and you're really bringing people together, and you're making a decent return on capital on each center.
Sure.
So very underwritable and sort of a nice situation. I mean, Lenskart, again, we've looked at it 3 times in the past, right? And it's part of that example, right? Other rounds have happened before us at lower valuations. But, the characteristics that I described again, right? One part of the business doing really well, certain other experiments going on which would have lost money, etc. We weren't comfortable with those, either projections or those thought processes in terms of how do you want to build the business. And so we politely parted ways, a couple of times in the past. But now as it continues to scale and build, now it's no longer, it is truly a hybrid business.
Absolutely.
Right? It's online sort of playing out in offline playing out in online, its synergies are truly visible. The number of store openings that they have, physical stores, is actually bigger than most other retail.
Some 1,400, 1,500 stores now.
Open 400-500 stores a year.
Yeah.
Right? So it is, it's a real company. Right? With real revenues, with real profitability, you can underwrite it, you can understand that. And it's not as if they're not taking the risks. They've gone and bought, on days from Japan and, other markets and expanding that. But I would say those experiments are much more limited, right? And they're figuring that out, and it's become a mature company, right? Still growing really well, right? We're not talking 15-20% growth, right? We're still talking 30, 40, 50% type of growth rates, right? So you still have the opportunity to continue to grow, and it's profitable and underwritable from our perspective. So really like that, and great founders, appreciate the obsession to the customers, right? Really looking, even today, right? That's what we love. I mean, you take, switching gears to another very successful companies of our Mankind. I mean, the founders even today, would be traveling 15 days a month in the interiors of India, right? The rigor on execution is relentless, right? And hasn't changed in all these years. And so, that's what differentiates, good businesses, which continue to grow.
Absolutely. No, but that's a great point. I mean, so much of being an investor is having the pleasure of working with such great founders, promoters. Could you perhaps highlight some more phenomenal traits that you just taken from great operators, folks who've built successful businesses? What is it that we can learn from them? And also, very often as investors, we talk about pattern recognition, part of being able to recognize such talent before the world starts to appreciate it in its full, right? To recognize gold before it's gold, perhaps. What has that been like? So the recognition part of the journey and the learnings from founders.
So I'd say, some of the common traits I'd say is, of course, execution. I think a lot of the youngsters I meet, and people who are aspiring to build, companies and all of that are very enamored with the, path-breaking ideas, right? That will come and change the world, right? We had, back in 99, 2000, we had a company called Chiku, right? Which was a bar on the top of on the bottom of your screen, which is like Google.
Okay.
It was defined as, so it's, the ideas existed back then, right? In terms of what you can do and all of that. I think it's the execution that makes the full difference of what really plays out or doesn't. And I want to call that out to, anybody, young entrepreneurs watching this show and otherwise as well, right? I talked to this in my class in Ashoka as well. Don't get enamored by ideas, right? The number of entrepreneurs I see looking at, very mundane problems that they're solving, right? Which you may not see it on a day-to-day basis, but building huge companies, just solving those problems is just phenomenal, right? That opportunity exists in almost everywhere in India. Maybe not so much in the Western world, but in India, a lot of it is fixed. We are still in the fixed economy situation, and therefore there's a lot of fixes that can create great companies. You pick the thing that you're passionate about and where you can execute well, and you have a natural edge to do that. So I think good entrepreneurs see that and play to their strengths, right? Good investors also stick to their knitting, what they see, where they have some sort of a natural edge, either built organically or over time, right? As opposed to getting excited about the nicest, fanciest term that they have the faintest and vaguest idea about. I think the question, at least I ask myself, is how would I react, to the first, downturn that I see in this business, right? When the numbers are, hitting the shitters, right? And the entrepreneurs coming to me, would I even know what metrics to track, right? And how do I get a better handle of, while this idea looks interesting, but if I don't have an answer to how do I handle a downturn, and how do I, what are the metrics that will help me get comfortable that I have the confidence, doesn't matter what the financial numbers are, the business is going in the right way, basis the metrics that I can track. If I don't have that understanding, then I probably am not the right investor for this asset, right? So I think that's also important to recognize. What are you not going to do? Right? What are your no-go areas, and what are you not sort of well inclined to do? The other thing I would say is just having the risk, I wouldn't say risk taking, but I would say it as having the ability to be different, right? I'll give you an example. Shriram Transport, right, made a nation use truck financing, right? Ashok Leland, Chola, everybody was at that point in time was doing new truck financing because that's an easier thing to do, right? All the banks only financed new trucks, and that's the model. You were investors in Axis Bank. We had only seen that, right? And so when we talked about truck financing, our view wasn't that great. I mean, it's a commoditized business. You have a bill, you finance it. The guy with the lowest cost, of funds wins, right? So it should be with the banks. Why should it even be with an NBFC or somebody else? And okay, fine, it may be with an NBFC because you have some, relationship edge or something, but there wasn't much of a, differentiation. Then we met Mr. Tyagarajan at Shriram Transport, and then he explained, that no, that's only, this. You're only talking about the flow of new trucks. What about the stock, right? And his insight was that, look, a truck the engine that's built never leaves the road. They fly national highways first, then 5 years later they move to the state highways, 10 years later move to the local highways, then eventually find that, gets taken out as a, village, something, and then eventually as a pump, that engine it never really dies. It has a 25-year life, and you can finance it through, various aspects in the way. So doing something different where the rest of the crowd is not doing it. Good entrepreneurs have created, great niches, but trying to do something different. Mankind, right? Going into the interiors where Sun Pharma, everybody was, I'll say, focused on the top end. The MNCs were focused on the top end. So the common understanding was you can't have employ a sales force agency and with a productivity that low. But these guys figured that there was nobody serving the underserved market, the bottom of the pyramid. So we'll go and execute and build a cost structure that is suited for that. So good entrepreneurs, have decent strategy solving a different problem. In all these cases, it wasn't hard to see it. Once it was articulated, it wasn't hard. So it wasn't on the gold on the come as you articulated it. I think we don't, that is from an investment lens, I would say, don't invest in gold on the come. See the gold, right?
Identify it before it becomes commonplace gold.
When that gold has the ability to scale, right? Come in when you have like 3%, 5% market share, as opposed to Shriram Transport went from 5% market share to 40% market share. We were the providers of capital. That's how we returned, made 10, 12 times our money, and then subsequently also other investors have made, continue to make money with that. So
that's very commendable. Again, I think these are strong insights for founders building, and I think the important part that like the founder journey does not stop at like building a company and taking it public. It starts there. I think that's an important one. I think as we go towards the end of the conversation, this has been super fascinating. I'd love to also understand like inward-looking things. We've spoken a lot about what the job in and of itself has to offer from an outward lens when it comes to investing, adding value to companies, learning from founders. However, building Chris in and of itself as an institution, maybe having the next generation of investors come in and build alongside, going through a transition of leadership when the founder Ashish left. How have some of those instances perhaps shaped your inward strategy? What does leadership at Chris look like? What is the culture like? What are things you've done successfully to be able to build the franchise as a strong institution, the strongest perhaps in PE in the country? What has that been like for you, Sanjay?
I mean, we've been just very fortunate to have the nicest set of people that you could ever want to be with, right? Sure. It's an interesting, I've been asked this question many times that would you look to start something of your own? You're at been in India for now 25, but I was asked this question 15 years earlier, 10 years earlier, various points in my journey, right? And I'm like, I'm fascinated about building, investing, fascinated about building a great firm out of India and doing that. And when I try to answer that question in a different way, saying, look, what would that look like, right? And I'd say, what would I need, right? I would need a team of very smart people, right, to come and work with, who are fun, but not just, but at the same time very smart, who I can look up to, respect their opinion, who have the right set of values, right, will not cut corners, whom I can completely trust. And what does it take to build that team, right? And said, okay, so if I were to do that, who would I bring, right? And it would be the same team, right?
Wow.
And that is the answer. That is the beauty of ChrysCapital, right? It's essentially an all for one, one for all culture, built by people who've stayed there, seen it, learnt it. I like a lot of things about the firm, from a firm culture point of view. I like the fact that people can be completely blunt and transparent. It is a completely apolitical place. You have a investment committee structure where we discuss things threadbare, where when we vote, everybody goes around the table, and more importantly, our junior most folks people go first, so we don't end up influencing. You want to make sure that the insights of the new generation, everybody is also coming to the table, and they feel accountable.
Sure.
For that decision. They know that there's going to be asked off of them, right? So I love that. I love the learning that goes through, because you end up having these conversations. Every Monday we're sitting around talking about some of the best businesses around the country. There's a cumulative learning that kind of builds, right? I love the fact that nobody wants to go anywhere near a gray line, right? You want to be absolutely clearer, and then everybody is, and it's not imposed from somewhere, right? It's like the deal teams themselves saying, okay, I'm worried about this and I'm worried about that, right? And everyone else, also sort of even tightening the scope further and saying, look, we have to be, we have to be clear and work in that direction. So that's just a fascinating place to work. So leadership, I guess, has basically it's been a place. The other thing I'd say is it's always been pick an area, do well, grow. There isn't, you have to be siloed on this or that area, right? People have moved from investing into fundraising. People moved from, in value creation team got built over time. There have been different roles, and people have grown into, leadership roles over time. And nobody's tried to box anybody down and say, listen, you're here, you need to be only in this box or that box. And there's, of course, our own offsites, which are a lot of fun.
Nice.
We do it with spouses. We have 55 people, and we're still managing to put it together. In future we'll see if we continue to grow. So this is the first year we actually divvied up our offsite into one is with spouses and one without spouses, because it's becoming too large.
Yeah.
But I often say that we've actually literally gone through maybe 20 offsites.
Yeah.
With folks and their spouses, probably more occasions.
Yeah.
Than with
you
my
take
own
as a family.
With my own family, right?
Yeah.
And so you get really close.
Absolutely.
Over time, and that's what you value, right? I think as a culture, which is what's kept people together. Of course, it needs the organization to be successful. You need to do certain things right, professionally, right? But over and above that, I think these two things, just a very collegial environment, all for one, very family oriented culture, I think is what's stood us.
Amazing to hear that. I think all of it just sounds so wholesome, and it feels like a very growth oriented place which values the people around, and I think that speaks volumes of the place. A more direct question perhaps, Sanjay, would be that a lot of people listening to you would also wonder what it means to succeed in the ecosystem as a PE investor, and that's the more direct way to understand what does it mean to be successful in the objective terms of it. Of course, Chris as a firm has done really well, but what has your pattern been to identify young investors who have a knack for investing and can do well in PE? If you had to summarize some really strong pointers for youngsters looking to build a career in the space, that'd be really fascinating to hear.
See, I think depends on what your orientation is, but a lot of people from the investment background tend to focus a lot on valuation.
Sure.
Right? What's the right time and all of that. And I think, look, it's not a science, right? We know it's an art. Valuations, it lies somewhat in the eyes of the beholder. You'll do all the justifications for it. You'll do your DCFs. You'll do whatever multiples you want to do. But at the end of the day, you can play different, angles to it. I think, to me, one of the big learnings has been focus a lot more on the quality of business, right? Quality of entrepreneur, right? I would start with the quality of the entrepreneur. Everything starts there, right? If you're backing a minority company or if you're doing a control deal, then the quality of the leadership team that you can bring to the table, right? And then it's about the quality of the business, right? Through its metrics, through its cycles, what is it demonstrated, what does it tell you, what else is left. I think investors spend far lesser time than they should, in my opinion, right? They should obsess over what's a good quality and do they really understand, right? If good quality, right?
So instead of the numbers,
it's defined by the numbers.
Okay.
Right? It could be by the numbers, it could be qualitative factors as well. But what defines high quality business? Is it one where your entry barriers are high or low? Right? What is the differentiation?
Sure.
Right? Relative to what are competitors really talking about you? Right? What is your soft underbellies in your business? Right? I think these are types of things that investors typically spend lesser time on. Right? Very, very important to understand, because if you're going to be owners of a business over a 8-10 year period of time, you need to be able to react in every situation. This business is as much about temperament than it is about intellect, right? When to sell, when to not to sell, how to add value, what to do, all of these decisions you'll make jointly with the entrepreneurs.
Sure.
So you need to understand their businesses deeply, and that comes from living through these cycles, but then asking these questions and really understanding business quality and how can you improve the quality between when you enter and when you exit. How are you moving towards that?
Yeah.
If you have a good entrepreneur and you have a good quality business and one that can scale, that's the third thing. One that has an opportunity. Shriram Transport 4%, 5% scale, HDFC back in the day, whole market to scale, health insurance today, whatever, right? There are various segments of the market that have an opportunity to scale. So if you have scalability as well ahead of you, valuation will fall in place. I mean, of course, you have to avoid the absolute. I think the key is to understand if you are in a nutcase zone, right? Which is, which oftentimes, there are absurdities and
21.
Yeah, and overall market or in your subsector, right?
Sure.
And that is very easy to do if you look at 10, 15, 20 year data and see what your historical multiples are to today. And if you see your multiples today are like 50% higher than what they were, 3-4 years ago for the same companies in the public markets or wherever else, it tells you got to be really cautious, right? On the valuation on that aspect. Beyond that, fixating on, 18 times or 15 times or 16 times, I think doesn't. Bigger mistakes are going to be made on the first two buckets, whether you pick the right entrepreneurs and whether you pick the right business, right? Or you fix the scalability, then the valuation side.
Got it.
And sometimes also I would say understanding the regulatory framework and the tech side of it.
Sure.
To say, is tech going to disrupt your business, right? So we back to newspaper business for, and only live to see that shift that, not that I can be proud of, right? So it wasn't that we didn't have the foresight to see, that disruption was coming. We felt that Hindi would not get disrupted as much because, it's a metro phenomena where news will be consumed on the phone as opposed to people who want to get your jobs and everything, and therefore that has many more legs to go. But I think, as we've seen internet expand at all of India, right? That has changed. So sometimes, I think a good question to ask is technology helping you or working against you?
Sure.
Because in the long run, technology, if it's working against you, you tend to underestimate how much it can impact you.
Sure. So
in the short run,
is also very
in the short run you overestimate, in the long run you underestimate.
That saying is there. But phenomenal. I think the North Star there that I'll keep in mind is perhaps just assessing the quality of a business, right? Like, what is your bar for that and how do you assess it? That stood out from your words. It's interesting, in parts throughout the conversation you mentioned some repetitive wins. You've also mentioned some things that didn't go right in your 25 year career. If you had to really highlight some maybe mistakes that really taught you for the long run, and also equally maybe some other distinct wins that taught you. We all love a great story, so maybe wherever you can mention names as well, that can be helpful. But what were these, pivotal things that made you realize mistakes that you would have never repeated afterwards? Never is a strong word, of course, but you would have really been cautious of, but also wins.
So, and maybe I'll give a personal sort of narrative around it as well, right? So, as I mentioned, in my early years, I was a lot more oriented towards value, right?
Sure.
And so I was looking at, low PE multiples, saying, look, I can't, that at least I know I'm getting this return back for the amount that I'm paying. How can I be wrong, etc., etc. If you can get a good business at a much lower, your margin safety is that much more. This was my second and third year at work or something, and I used to there's this company called Morapin Labs back in the day, right?
What did they do?
They were a pharma company doing, leaders in some drugs like loratadine and, a few others. I still remember it because, it's painful when you lose money. So what I would end up doing is I would, this used to trade at 8-10 times earnings. I used to love this company, it used to grow nicely. The numbers were phenomenal. Market leaders in their particular molecules. I'd end up, taking my entire salary that would come in every month, religiously go buy, whatever I need. Other than that, would go into, the stock.
Right.
And for a few, months and almost years, I continued doing this, right? Until one day this company went under, right? And I followed it down all the way to zero, right? It was a painful lesson learned personally, right? And it was basically essentially entrepreneurial quality, business quality issues, right? That played out here. One doesn't know the exact story because this was not a ChrysCapital. I'm talking about personal investment here. But, so you learn from some of those things that, cheap is not necessarily the best.
Good.
And we learned that painfully in the 2009-10 cycle again, right? So sometimes it's better to cry only once when you pay up and, as opposed for higher quality, better business. In India, that's really been something that's stayed well, for us. Lots of learnings. I mean, I think betting against technology, we covered that aspect. I think, investing in businesses that have the staying power. If you're go through a recession, I think when to buy, so we've by default been contrarian to some extent, always being, it helps to create the alpha, right? If you do that. But when you're contrarian in a tougher business, you may not last the cycle.
Yeah, and the alpha may not be justified there also.
May not come out only.
Got it.
If the cycle is shorter, you probably come out.
Yeah.
Right, and make so. But if you like to compound over a longer period of time, even 2-3 zeros are very hard to recover, right, on a large base, as opposed to just going a little bit, instead of swinging for the fences, you do some safer businesses and try and compound that longer.
Sure.
Sorry, is a lot easier, I mean, look, winners, there have been plenty, right? We've talked a lot about them, but I think, frankly, winners don't teach you as much as losses do, right? And the good news is you can learn from others' mistakes also. It doesn't have to be, it doesn't have to be your business, right?
Sure.
And frankly, the best thing about our business is that, you don't have to, for a good private equity investor, right, looking to make a career out there, you see some of the best private equity guys, they probably sat on 7 or 8 boards in their lives.
Yeah.
It's like 7-8 investments that makes it. I tell this to everybody in ChrysCapital, right? You should aim to have, those, you decide which those 7-8 are, right? They have to be the highest quality names, which then turn out to be the future Mankind's, the future Intas's, the future, AUs of the world, right? And if they are those, then you've, created a real name for yourself, right? You'll find the next lens cards and all of that. But imagine you only have 6 shots, right? And you, as I mentioned, we looked at 200 deals a year. If you're a average person in the firm, you're probably still seeing 25, 30. Every week you're seeing one investment, if not, or maybe so it's always, it's you're like excited about. You'll say no to 2, 3, 4, and the 5th one you'll get excited about. It's better to figure out which ocean you want to swim in. Right? Fix the better businesses and then really ask yourself if it's meeting that bar.
Very fascinating. I think that's super helpful. I think one of the questions as I was collating in, what to ask was The difference between, let's say, maybe a new age founder vis-a-vis, let's say, maybe promoter driven businesses which are perhaps from the 2000s range, right? Is there any significant delta that you have observed with like new age companies vis-a-vis some of these other founders, promoter driven businesses, family run businesses? What are the nuances there that maybe you can highlight? And because sometimes the public narrative with new age founders, unicorns, VC can be very new age specific, but some of the largest businesses in the country are still very promoter driven. How does that world function, and what is that life like?
I mean, let me, without going to new age for a second, but I'll give you a different, try to answer the same question.
Sure.
Take Infosys,
Yeah.
right? Some of the best businesses in the country, great return on capital businesses, right, have some of the lowest risk-taking appetites.
Yeah.
Right? It's hard-earned money, they just don't want to risk it, right? Back in the day, when we were investing in Infosys or around that time, we'd have all these conversations around, M&A opportunities, you could do this, you could do that, do faster and all of that. And they would be like, oh, I need 6 months of payables, salaries in cash, I need $1 billion, etc., etc. They wouldn't, part with that.
Sure.
Over time, of course, they've now, developed, and all these companies have, evolved and become much more sort of open to M&A and built their own sort of practices, because capital allocation is an equally important, business function for a business that generates the capital, right?
Yeah.
At the same time, in 2009-10, we were investing in a lot of the, at times in the mistakes that we made in the EPC companies, engineering, infrastructure companies. And, they weren't generating much cash flows at all. There was a lot of leverage on the system. But the kind of risks they were willing to take, whether it was the next project and committing the next kind of capital would, have us like really worried, right? And so we were looking at, both these in the same, in the contrasts in our portfolio, and it does tell you, right? If you don't have it, you're willing to swing for the fences. If you have it, you're not willing to do anything with it.
Yeah.
And maybe the answer lies in the middle, right? As you kind of professionalize and do that, that's probably a better way. I think certainly in new age businesses, right, they're willing to do things unconventionally and differently, and they need to, right? Sure. That's what's gotten them to the point. I think I am not equipped and qualified to be able to say what, the reason there's a high loss ratio is also because of that, right? You're trying to do different things, and not everything's going to be successful.
Work,
yeah. But once you've gotten that, right, I think you keep the core, and you have to limit your experimentation to a few things that will turn the needle.
Sure.
For you, right? I think that, that understanding, and that is a common thing that that's something that we can, take from the new age companies and apply that to other companies, make them a little bit more risk-taking. But the flip of it is also to understand not to bet the farm, right? How do you do it in a way where, I mean, lots of examples. Suzlon at the height of it was 10 billion plus market cap. Eventually, did bet the farm with 3 large acquisitions all over the world, right? Yeah. With large debt. And I think that's what you got to avoid, right, in terms of risk-taking appetite.
Fair enough. I think that helps. I think risk-taking ability has to be, the answer is in the middle. I think that's the one I'll take back. But this has been very fascinating. I'm so glad we've done this range of, we've covered this range of topics. As we conclude, I have a list of similar questions that I usually ask, which are more personal oriented. So we'll probably end with that. One of the first ones there is, if I had to ask your friends to describe you, what would they say?
You got to ask them.
Yeah, I'd probably ask Ashish, who recommended that, we should have this conversation. But if you had to take a stab at it.
See, I'd say that they'd describe me as analytical, they'll describe me as loyal, right? They'll describe me as somebody who'll stand by them, right?
Those are all good values to be defined as. But usually...
Maybe, drinking away like Ashish does may not be top of that list, but the fun-loving quotient may be a bit lower.
Sure. No, but I think I always receive an interesting answer here, because it's always good to perhaps describe yourself with the eyes of maybe friends. And the second one is actually, considering you're an investor, you've spent so many years in investing. If I had to ask a group of your founders, the ones you've backed and partnered with across a period of time, what would they say about you?
I think for me, try to keep it consistent and ethical. So I don't think there's that much of a difference between what my family would say, my friends would say, or my founders would say.
Got it.
It is, bring authenticism, and I'm pretty. You also know where you stand with me.
Sure.
Right. So in terms of my views, they're very transparent. With
Got it.
with the with the right intent, right? And
Sure.
people kind of just get that.
And no multiple personas to you, just the pretty much one. Awesome. That's lovely to hear. One other thing that we also ask is, what is that one superpower that you have and you exhibit almost always, and at the same time, if you could highlight one thing that you are feared of or you fear.
Okay, nice one. Superpower, I would say, look, I think I use my data pattern recognition, right, across industry to another, ability to relate IT to financial services to pharma to, across different common patterns across different founders, and use that very effectively. That'd be my superpower. I'd say I'd use that very effectively.
Pattern recognition.
Yeah, I would say also just ability to, hustle, I guess, and trying to push the boundaries on what I'm, what I'm working on.
Awesome.
Those two would stand out. Sorry, what was the other one? The
one thing you fear.
I fear bureaucracy. I fear lack of ambition. Right.
Got it.
I fear lack of intelligence. Right. And just
all the things that you exhibit already, you would fear not having them, perhaps.
Yeah, I mean, I just also, I wouldn't thrive in
those
environments. Yeah.
Fair. Oh, but that's super helpful. The other thing, that really fascinates me is, as a founder, as an investor, you've seen so much of what has changed, what has worked. If you had to take a forward-looking lens of what will work, and that's the shortcut perhaps that everybody wants an answer to, and there can be no perfect answers, but if you had to take a, 5-10 year view to India, considering you've seen multiple cycles, multiple sectors really do well, what does that look like?
See, look, I think India, it's in a very, it's a sweet spot, right? I think India is going to get richer, right? How much richer is the question, right? So if you're a 45-year-old, you're thinking about college admissions for your kids. If you're a 30-year-old, you're thinking, your first house. If you're a 25-year-old, thinking marriage, right? And then you're thinking honeymoon, and you're thinking, if your income X, you're thinking, overseas. If your income Y, you're thinking Y. And, it's very, very broken down exactly by, those are cohorts that you can almost predict and, play out. Sure. So India is going to go through that consumption sort of boom, clearly. I think we're going to see a continued growth in IT and IT services. Frankly, this is where the world works.
Sure.
Right? If you think about the population of the world between 18 to 30, India is probably a third of that. Yeah. And this is where the the eventual work of all kinds will get done. And so you can use this population to do lots of things. So there is going to be a big play in IT, SaaS, whichever way you want to cut it, from a workflows of the world kind of a play. Manufacturing, I'm not sure, right? A lot of talk about it. There's a lot of government push towards it. China +1. I think it's for sure not China +1, right? It's for sure China +10 that's playing out. Mexico's played out. Vietnam's played out. Lots of different economies are played out. India has its opportunity, right? And to actually benefit from that, but it will not be only one economy that will benefit. How much will benefit and which types of things is probably unclear, right? And from investment lens, when you're unclear, you don't swing. So you just sit it out, right? And kind of watch it play out, right? When you invest when the gold is already there, not when it's going to be there. So I would say, I think there are lots of catch-up demand in India, right? India, like for example, insurance, right? Health insurance is something that is so underpenetrated in India. We are, moving from a self-pay to a, where everywhere else in the world, it is an insure-pay market. And so health insurance is something that will grow to be a much larger market for sure, right? Similar segments, right? You can go, there's so many of these things which are not built out in India.
Sector you could go out
wealth management, whole equity culture in India. As wealth, as Indians get richer, they will save more. Equities is a big theme around that, right? So we are investors in NSE, the continuation fund that you talked about, all of that as well, right? So those are themes that you can play in from a long-term perspective. I think it's frankly a lot easier to see the longer term than it is to see what's going to happen in the shorter term, next 1 year, 2 year, right? Yeah. So for those reasons, and most of all, what you alluded to, the honor and the the real sort of ability to work with Indian entrepreneurs and the entrepreneurial talent that exists is why I'm most optimistic about India, because we have some amazing talent here that has the ability to execute on the potential, right? So you pick your bets, and the key is not to make mistakes.
Yeah. Lovely. I think that's super interesting. I think it covers so much ground. This has been an absolute pleasure, Sanjay. I mean, one thing that I want to end the conversation with is perhaps this overall stereotypical question that I ask most people, but we turn back the clock and take you back to perhaps the day you were joining Chris, and if you could perhaps tell yourself a couple of crucial learnings that in hindsight you've gained from 24 plus years of investing, 25 years completed for Chris, what would you tell yourself? This is just to put things into context and just summarize everything that you now know. So this is not about regrets, by the way. This is just about if you could tell yourself everything that you today know, what the alpha would have been. So yes, would love to know that, and I think that'll be a lovely end to the conversation.
Oh, thank you, and it'll be a summary of a lot of what we've discussed, right? Look, and it'll apply to any sort of youngster sort of coming into a private equity venture
Absolutely.
world and all of that, right? I think you have to dream big. I had that coming in. I wish if I were to go back, I'd say continue dreaming big, right? When I started out my career, what I aspired to do, I love the fact that I haven't yet reached there, right?
Lovely.
And so it's not a journey that shouldn't, because if you have smaller aims, that they get reached very quickly,
faster, yeah.
right? And so you should dream big, and I had that, and I love people to come in and other people to come into ChrysCapital or other places to actually dream that, right? The fact that believe that a great world-class institution can be mailed out of India, right? I think we've kind of gone ahead and proven that. I would want to tell myself, 25 years ago that can be done.
Yeah.
And, we are still in the process of doing that.
Sure.
And I think, over time, we feel that we will really build a world-class institution out of India. And that's a journey.
Absolutely.
From an investing lens, I covered some of those aspects, right? When you think about entrepreneurial quality and business quality, higher and above just valuation, right? Scalability as well, right? These three things are like the most important things to think about. And then just avoid the bubble territories.
Sure.
By and large, you'll end up, being fine. I can't overstress that. I think almost all my mistakes that have been made have been because you've gotten carried away, right?
Sure.
Because ultimately, this is a business of greed and fear, right? And markets are about that. The beauty of the private equity space is it's a little bit more removed from the listed space. You're not looking, so the greed and fear can be a bit lower, right? And but even if you're investing in the markets, you've got to tell yourself, stay away from the greed and fear cycle and look at the business and focus your energies on that. I reiterate that to myself and stay sort of, treat both imposters, bear markets and bull busters, the same than the poem, if and the world is yours, right? I think is probably something that I would reiterate to myself. I think that is clearly these two are imposters, but neither of them are longer lasting. You know that the reality is somewhere in between.
Sure.
And you have to kind of, follow the data and keep the bar high in terms of, what you invest in.
Sure.
And also over the years, it's not just about building, it's a combination of investing, but also leadership and building an institution, right? So you have to do, it's about building the right teams, doing the right things, building the right culture. Those are equally important. I think you realize it later as you kind of build that's frankly even more important, so that it pervades the organization.
Yeah, it's
so
larger
you really
than you.
build. It's larger than you. It creates longevity and lasts beyond yourself. So
awesome. But no, lovely pointers. I think dream big, India story, and avoid mistakes. Those are a couple of key highlights I will take away from the conversation. But this has been so enriching and full of learning for me personally, and I'm sure for the audience, because we've covered a lot of ground. Thank you so much for being your candid self and sharing so many of your learnings and telling us how ChrysCapital is what it is, and sharing your learnings from incredible 25 years of investing and building a premier institution from India for the world. Thank you so much for being on the show, Sanjay.
Thank you. My honor to be here, and really appreciated how you conducted it. Thank you so much.
My pleasure. Thank you so much.
Hello. If you made it this far, you've probably watched the entire episode. And if you've done that, I'm really grateful. I and my team try to put in a lot of effort to ensure that we can bring the best quality content to you. So if you liked the episode, if you watched it thus far, my request to you is to share it with people, to subscribe to the channel, and to ensure that we can keep growing. We are everything and anything only because of you, our listeners. Thank you so much for tuning in. We'll keep bringing to you amazing content. Cheers.